All right. Welcome back, everybody. Today, we're diving deep into the world of buy now, pay later.
Oh, interesting.
Yeah. Specifically, we're looking at this company called Sezzle,
Okay.
which you may or may not have heard of.
Hmm.
Um, they've kind of been making some waves.
Yeah.
They've seen their stock price absolutely explode over 2,000% in just the past year,
Wow.
which is
That's wild.
pretty wild. Yeah.
Yeah,
But that begs the question,
of course.
is this rocket ship, headed for the moon, or is it headed for a crash landing?
Yeah. Right?
So we've got this really interesting report from Hindenburg Research. And let me tell you, this thing is raising some serious red flags.
It is.
Okay.
Hindenburg is known for these really in-depth reports, these investigative reports.
Right.
And they're not just observing Sezzle, they're actually betting against them.
Interesting.
So they've come out with this short report that claims that Sezzle's success might be more illusion than reality.
More smoke and mirrors than
Smoke and mirrors, exactly.
substance, yeah.
Yeah.
So let's unpack that a little bit.
Sure.
One of the things that Hindenburg is claiming
Mm.
is that Sezzle's sky-high valuation, I mean, it's a whopping 5.5 times their projected future sales,
Which is,
which is huge,
yeah.
is built on some pretty shaky ground. They even call it a house of cards.
Yeah, a house of cards.
Pretty
That's
bold.
low.
That's a pretty bold statement, right?
Yeah.
Where are they even getting this from?
Well, they start by focusing on Sezzle's performance in Australia.
Okay.
Before they landed on the NASDAQ here in the U.S., Sezzle's was actually listed on the Australian Securities Exchange.
Interesting.
Yeah. And their time down under was, well, let's just say it wasn't exactly smooth sailing.
Oh, what kind of trouble were they getting into down there?
Well, they face accusations of misleading marketing,
Okay.
hiding crucial information from their shareholders,
Uh-huh.
and engaging in some pretty high-risk lending practices.
That sounds a little familiar, right? It's like that old saying, wherever you go, there you are.
Exactly, yeah.
They bring the trouble with them.
They bring the trouble with them, exactly.
Yeah.
And, it's interesting because their Australian adventure ultimately ended with a pretty dramatic stock collapse.
Oh, wow.
Fueled by these reports of massive bad debts. There were even whispers of bankruptcy.
Yikes. That's not exactly confidence-inspiring, is it?
No, not really.
So how on earth did they manage to make such a splash here in the U.S. after that whole debacle?
Well, that's one of the big questions Hindenburg raises, right? They're suggesting that Sezzle may have, kind of pulled off a bit of a financial makeover, making their numbers look a lot prettier than they actually were, especially in the lead up to their NASDAQ listing.
So a little bit of window dressing for the big debut.
A little bit of window dressing, exactly.
So what specifically are they pointing to there?
Well, one key detail they highlight is this dramatic reduction in Sezzle's provisions for bad loans in early 2023.
Okay, hold on. Let's break that down for our listeners who maybe aren't fluent in financial jargon.
Yeah, sure.
What exactly is a provision for bad loans, and why is this such a big deal?
Sure. So a provision for bad loans is basically just like setting aside money to cover potential losses from customers who don't repay.
Right.
So it's like a rainy day fund for bad debts.
Oh, okay.
Yeah. And what Hindenburg found was that Sezzle drastically shrunk this rainy day fund right before they went public in the U.S.
Now, that's interesting. Is there any chance that this was just a coincidence?
It's possible.
Maybe they had a really good quarter with exceptionally low defaults?
It's possible.
Or something like that.
But Hindenburg argues that the sudden shift looks more like a temporary fix, to make their financials shine a little brighter for potential U.S. investors. And they suggest it may not reflect the true health of Sezzle's loan portfolio.
So potentially masking some underlying problems.
Potentially, yeah.
And remember, we're talking about a company that's already borrowing money at a pretty steep interest rate of 12.65%.
Steep, yeah.
To fund these loans to what they themselves admit are extremely high-risk customers.
Right.
It's starting to feel a little bit like building a house on sand, isn't it?
That's a great analogy.
A little shaky.
Yeah. And then to add to that, Hindenburg also points out that Sezzle's CEO, Charlie Youakim, pledged a huge chunk of his shares as collateral for a margin loan.
Okay, hold on.
We're talking about $542 million worth, which is almost a third of the entire company.
Whoa, whoa, whoa. Okay, let's back up for a second. What exactly is a margin loan?
Sure.
And why is this a big deal in this case?
Yeah, so a margin loan is essentially like borrowing money against your stock holdings. So it lets you tap into some of your stock's value without actually selling it.
So it's like getting a cash advance on your stock portfolio.
Exactly. Yeah.
Interesting.
But here's the catch. If the stock price drops significantly,
Right.
the lender can issue what's called a margin call.
Mm-hmm.
This means that the borrower, in this case, Sezzle's CEO,
Yeah.
has to either put up more cash or sell some of their shares to cover the loan.
Oh, I see where this is going.
Yep.
So if Sezzle's stock starts tanking, their CEO might be forced to sell off a big chunk of his shares, which could push the price down even further, right?
Precisely. And that can create, a bit of a downward spiral
Right.
and shaking investor confidence and making a bad situation even worse.
Now, I'm not saying that the CEO's panicking or anything,
No.
but it does make you wonder, why would he risk such a large portion of his holdings if he was completely confident in the company's future?
It certainly raises some questions, doesn't it?
It does.
Especially when you consider that Hindenburg also uncovered evidence that other Sezzle insiders were quietly selling off millions of dollars worth of stock this year.
Oh, really?
Yeah.
Tell me more about that.
Well, one of the most notable sellers is a pre-IPO investor called Continental Investment Partners.
Okay.
They've actually slashed their stake in Sezzle by a whopping 87%.
Wow, that's a pretty dramatic exit. They must have seen something that made them want to get out while the getting was good.
And they weren't alone. Sezzle's co-founder, Paul Paradis, also reduced his holdings by a significant 43%.
Okay, now I'm not saying that every instance of insider selling is a sign of impending doom,
Right.
but it does make you wonder what these folks know that we don't, right?
It does.
Is this a case of rats deserting a sinking ship?
Well, it's definitely something to keep an eye on.
Yeah.
Especially when you combine it with all the other red flags that Hindenburg has raised.
Right.
It really starts to paint a picture of a company where those with the most insight are heading for the exits.
Yeah, and that brings us back to the central question. Is Sezzle's meteoric rise truly sustainable, or is it all just smoke and mirrors?
Yeah, the big question.
The big question. We're just getting started with this deep dive, so stick with us as we explore more of Hindenburg's findings and try to untangle this financial puzzle.
It's a puzzle for sure.
It is.
Yeah. So, so far we've really focused on Sezzle's kind of shaky past in Australia
Right.
and some of those questionable financial maneuvers that they've pulled. But
Yeah.
Hindenburg's investigation doesn't stop there.
Of course not.
They also dug deep into Sezzle's merchant network
Mm-hmm.
and all those, those high-profile partnerships that they like to tout.
Right.
And let's just say the reality might not live up to the hype.
You know, it's funny you should say that because I was just looking at their website,
Uh-huh.
and they boast partnerships with big names like Amazon, Target,
Yeah.
Nike.
Oh, wow, yeah.
I mean, those are some heavy hitters.
Yeah.
You know, if they're on board with Sezzle, it's got to be a legit service. Right?
Well, that's where things get a little murky. Hindenburg points out that these partnerships aren't quite as straightforward as Sezzle might lead you to believe.
Okay.
Customers can't actually use Sezzle directly at checkout on these platforms.
So, like, I can't just whip out my Sezzle virtual card and buy, that new pair of Nikes I've been eyeing.
No, not exactly.
Oh.
Instead, customers have to jump through this, an extra hoop.
Okay.
They have to use Sezzle's app to buy a Sezzle gift card for the merchant and then use that gift card to make the purchase.
Huh. That seems like a lot of extra steps.
Yeah.
For both the customer and the merchant.
It is.
You know, I can see why that wouldn't be very appealing.
Exactly. Just makes the whole process, less convenient. It adds that extra layer of complexity.
Right.
And, for merchants, it means they're not getting that, that direct integration, that seamless checkout experience that they kind of expect from a BNPL provider.
So it's not just about, the name dropping and looking good. These partnerships might not actually be bringing the actual value that Sezzle is claiming.
Exactly.
Yes.
And Hindenburg goes even further, suggesting that Sezzle might be inflating their active merchant count
Oh, wow.
to make their network seem larger than it actually is.
Wait, hold on. How can you even inflate a merchant count? I mean, a merchant is either using your platform or they're not, right?
You'd think so, but Hindenburg found this discrepancy between the number of active merchants that Sezzle reports in their, financial disclosures, which is 23,000.
Okay.
And the number that's actually listed on their website, which is only about 6,776.
Wow, that's a pretty big gap.
It is a big gap.
What's the explanation there?
Well, Hindenburg suggests that Sezzle might be counting inactive merchants,
Oh, okay.
or even misrepresenting the nature of some of those partnerships to boost their numbers.
So not only are the partnerships themselves maybe not as impressive as they seem, but the actual size of their merchant network might be questionable too.
That's what they're suggesting.
Okay.
And this trend of potentially misleading information, it continues when we look at customer complaints.
Oh, no.
Hindenburg uncovered this, this wave of complaints on platforms like Trustpilot and Reddit,
Yeah, I've seen those.
with customers claiming that they were unknowingly enrolled in Sezzle's recurring monthly subscription services, Sezzle Premium, and Sezzle Anywhere.
So customers are accidentally signing up for these subscriptions without even realizing it.
That's what they're saying.
That doesn't sound good.
It doesn't, and what's even more alarming is that Sezzle's own FAQ page
Oh, really?
seems to acknowledge this issue. They admit that users might be unintentionally signing up for these subscriptions during checkout.
So they're aware of this problem, but they haven't taken, like, clear steps to fix it.
Apparently not.
That seems like it raises some serious
Yeah.
concerns about, their commitment to transparency and customer trust.
Yeah, for sure. And it really speaks to a broader trend that Hindenburg highlights,
Uh-huh.
which is Sezzle's seeming reliance on, potentially deceptive tactics to boost their revenue.
It's like they're trying to squeeze every last dollar out of their customers, even if it means, sacrificing trust and transparency along the way.
Yeah, it's not a good look.
How sustainable is that approach in the long run?
That's a great question, and it's important to think about the bigger picture here.
Yeah.
Sezzle's business model, like many in the buy now, pay later industry,
Mm-hmm.
relies on attracting two very different types of customers.
Okay.
Right? So you have the merchants who are seeking a seamless payment solution,
Wow.
and then you have customers who are, who need help to manage their finances.
And those two groups often have kind of conflicting needs, don't they?
Oh, they do.
Like merchants want simplicity, reliability, whereas customers who are struggling financially might be more attracted to offers that seem almost too good to be true.
Exactly. And this creates a real challenge for BNPL companies, right?
Yeah.
How do they balance the needs of these two distinct groups?
Because if they prioritize one over the other, they risk alienating, a key part of their business.
Exactly. And Hindenburg argues that Sezzle might be failing on both fronts.
Oh, wow.
Right. They're losing merchants because their service is becoming less appealing,
Yeah.
and they're alienating customers with these questionable subscription practices and, what appear to be pretty risky lending tactics.
It's like trying to juggle chainsaws.
Yeah.
Eventually something's got to give.
Exactly, yeah.
Yeah.
And so that brings us to the million-dollar question.
Preaches.
What's the future of the buy now, pay later industry? Is it a fad that's about to go bust, or is there, some kind of sustainable path forward?
Well, I think we need to dig a little deeper into Sezzle's current situation before we try to, predict the future of the entire industry.
Yeah.
Hindenburg didn't exactly hold back in their report,
Yeah. They didn't.
and they uncovered some pretty alarming trends.
You're right. We've got a lot more to cover.
Yeah.
And, and remember, this isn't just about Sezzle.
Right.
It's about understanding, the potential risks and rewards of this rapidly growing sector of the financial world.
So we've spent, a lot of time talking about Sezzle's practices and Hindenburg's claims.
Uh-huh.
But I want to shift gears a little bit
Sure.
and talk about their leadership.
Okay.
I mean, who's steering this ship?
Right.
And are they even qualified to navigate these, these choppy waters?
That's an excellent point. And this is where Hindenburg's report gets even more intriguing.
Oh.
They take a close look at Sezzle COO Amin Sabzavand,
Okay.
who also happens to be their head of risks.
Hold on. Their head of risk,
Yeah.
the person responsible for assessing and managing the risk for a company that's, essentially built on lending to high-risk customers.
You got it.
Okay.
But here's the kicker. Hindenburg points out that based on his SEC biography, Sabzavand has absolutely zero prior experience in lending or credit risk management.
Wait, what?
Yeah.
Seriously?
His background was in academia,
Oh, wow.
working as a teaching specialist at the University of Minnesota.
So the person in charge of risk management for a company that's basically a lender has no experience in lending or risk management.
Yeah, it's pretty wild.
It's like putting someone who's never driven a car in charge of a Formula One race.
Right. It's definitely an eyebrow-raising detail,
Yeah.
and it makes you wonder how a company, with such a risky business model could make such an unconventional choice for such a critical position.
It's almost as if they're prioritizing something other than experience and expertise
Right.
when it comes to managing risk.
It's strange.
But what could that something else be?
That's the question Hindenburg leaves unanswered.
Hmm.
But they do point out another concerning trend, Sezzle's declining customer base.
Oh.
Their active customer count has shrunk by 20% since 2021, down to just 2.7 million users.
So not only are merchants jumping ship,
Right.
but customers are abandoning Sezzle too.
It seems that way.
It's like their value proposition is shrinking faster than a wool sweater in a hot dryer.
It's a pretty clear signal that something's not quite right.
Yeah.
And remember, this is all happening against a backdrop of rising credit card delinquency rates in the U.S., which suggests that, consumers are increasingly struggling to manage their debt.
So it's almost like Sezzle is swimming against the tide here.
It seems that way.
But if customers are leaving and merchants are, kind of distancing themselves,
Yeah.
how is Sezzle reporting such explosive growth in their paid subscriptions?
Right.
I mean, didn't their subscription revenue increase significantly?
It did, and that's an excellent question.
Yeah.
And it leads us back to those questionable enrollment practices we discussed earlier.
Right. Right.
Hindenburg argues that Sezzle might be artificially inflating their subscription numbers
Yeah.
by, accidentally enrolling customers in recurring monthly subscriptions without their full knowledge or consent.
So it's possible that those impressive subscription growth figures are actually fueled by customers who don't even realize they're being charged a monthly fee.
That's what they're suggesting.
Wow.
They highlight numerous customer complaints, again, on platforms like Trustpilot and Reddit, with people describing how they were unknowingly signed up for Sezzle Premium or Sezzle anywhere.
It's all starting to feel a bit like a bait and switch, isn't it?
Yeah.
Luring customers in with the promise of, easy credit.
Uh-huh.
And then hitting them with hidden fees and unwanted subscriptions.
It's certainly not a recipe for building long-term customer loyalty.
No.
And this type of behavior often attracts, unwanted attention.
Right.
Hindenburg's report mentions that there's already a class action lawsuit filed against Sezzle,
Oh, wow.
accusing them of hiding the risk of bank overdrafts from their users.
So they're facing legal challenges on top of all these other problems.
Yeah, it seems like the walls are closing in on them.
It's not a pretty picture.
No.
And it leads us to a much broader question.
Okay.
What does this all mean for the buy now, pay later industry as a whole?
Right.
Is Sezzle just an outlier?
Yeah.
Or are these problems, kind of indicative of deeper systemic issues within the industry?
That's the million-dollar question, isn't it?
It is. It is. I mean, the BNPL model is still relatively new,
Uh-huh.
and it's growing at an incredible pace.
It is.
But is it built on a solid foundation?
Yeah.
Or is it, kind of a house of cards waiting to collapse?
Only time will tell, but Hindenburg's report serves as a powerful reminder that, we need to be critical consumers, especially when it comes to financial products. We can't just blindly trust flashy marketing and big promises.
Absolutely. We need to dig deeper,
Mhm.
ask tough questions, and do our own research before we hand over our hard-earned money.
Exactly. Financial empowerment comes from being informed and making conscious choices, not from being swept up in the hype.
Well said. Well said. And on that note, we'll leave you with this final thought. As you navigate the world of buy now, pay later, and other financial products, remember to be skeptical, be curious, and most importantly, be informed. Thanks for joining us on The Deep Dive.